The fixed annuity market is a growing and increasingly more popular market of the annuity market. Sales levels are almost about $50 billion on an annual basis. And we're seeing that there's sort of been a blurring of the lines of distinction between the fixed annuity market and the variable annuity market. We're seeing more development of customized indices and also the extension of living benefit guarantees, which is increasing the popularity of the product.
The fixed index annuities, they are comprised of what we call levers, your cap participation rate and the crediting rate, which is usually based off of some form of index. The S&P 500 index, through our survey, is the most common index used. However, what we have noticed in recent years is there's an increasingly amount of volatility controlled or proprietary indexes. The challenge with the volatility controlled and blended indices is that they are relatively more complex and less well understood by policyholders. So that may create suitability issues down the road. We also surveyed companies the charges that they assess for their living benefits. 3 companies surveyed have average rider fees less than 75 basis points. 4 companies had the average rider fees between 76 basis points and 100, and 2 companies reported over 100 basis points. So there's a little bit of variability in that regard. Generally on fixed indexed annuities, the surrender charge protection is pretty strong. In terms of percentages, most of the companies have surrender charge protection between 7.6 and 10%, so which is considered pretty good. In regards to the duration, most of the companies on their remaining blocks of business have an average surrender charge protection of about 6 to 7 years. When new policies are issued for fixed index annuities, the most common surrender charge period is 10 years. However, we have seen some companies issue up to 15 years.
There was a large variation amongst carrier to carrier in terms of minimum and maximum income benefits, sometimes as much as 2 times over, let's say, a 20-year waiting period. The degree of variation is somewhat dependent upon when the policyholder can elect the income benefit. Many companies prohibit it to be elected immediately and instead require at least a 5-year vesting period. We also think that the differences in the guarantees reflect some degree of difference in an insurer's risk appetite, along with their relative experience of the product line and the relative richness of the guarantee, which could range anywhere from a 3% to as high as a 9% guarantee.
We'd like to thank AM Best for their contribution to our program. If you'd like to see more of the First Monday series, visit the AM Best website.